Hello, everybody, and welcome to our first time buyer webinar. Now, this is not just for first time buyers, but if you happen to be a first time buyer, I think you're going to get a whole lot out of tonight. I think we're going to cover a lot of ground. There's going to be a lot of new information. It looks like I'm looking at some of the names. Some of the folks that are on our webinar have been through my consultation, my recommendation call before. So this will be review for some people, but I'm really, really excited to talk about the things that get me excited. And that is people buying houses. So even if you're not a first time buyer, I got some agents here, some real estate agents are in our webinar. Hopefully they'll come up with some really good questions to ask as we get further along. So I'm counting on you guys to come up with some good questions, but it's going to be a lot of fun. You should have received an email from us, which has the PowerPoint presentation, the PDF of today's presentation. That way you can follow along. I'm always back and forth between, do I want to follow a PowerPoint or do I want to just kind of share the information naturally as it comes up? So I want to start with the PowerPoint. I can't promise that I'm going to finish with the PowerPoint, but I am going to finish with questions and give everybody an opportunity to ask any questions that they have. And yeah, we're going to go from there. So let me we got our participants here. Fantastic. Okay. So let's jump right in. This home buyer webinar, let's get into first, what is it and what is it not? All right. Hopefully you can see my screen. See what that looks like. There it is. I got the mini me in the corner here. Okay. So what is this first time buyer? Well, here's what it's not. This is not a sales pitch. This is not a commercial for Princeton Mortgage, Ken Jordan, the effortless mortgage. Okay. Maybe just a little bit, but honestly, I just want you guys to have all the information you need to make good decisions. Okay. It's not a rate quote nudge. Rates fluctuate. They're different every day. They happen to be at like 4-year lows, which is awesome, but that's not really what tonight's about. Again, tonight's about education. And it's also not about rushing into a decision. Okay. Rushing into a decision is the worst thing you can do. Being prepared, having this information ahead of time, single best thing you can do to improve not only your likelihood of getting approved, the likelihood that you're going to find the house and be able to afford the house that you want, the likelihood that you're going to have a smooth transaction. All of it comes down to proper preparation. I say this at every webinar, proper preparation prevents poor performance. And that's what tonight's about. Okay. It's about education. It's about clarity and it's about confidence. Home buyers that actually win are home buyers that are prepared to take action, prepared to make quick decisions in a meaningful way that's going to beat out the competition that's still fumbling over what would my monthly payment be if I went up $5,000. You're going to know and you're going to be able to make those quick decisions and help you win. And of course, understanding beats guessing. So that's what we're hopefully going to get into tonight. We're going to be together for about an hour. Like I said, hopefully you're going to leave here more informed. Okay. Let's start with, how do lenders decide what you are eligible to borrow? This is number one question that I get. How much can I afford? And affordability, ability, programs, all of those factors are important. But the mortgage triangle is the foundation for the beginning of everything that we do, right? And even when I'm in a consultation, sometimes I'll let my buyer know, hey, draw a triangle out on your piece of paper. This is how the underwriters are going to view your file. And at the very top of that triangle, you guessed it, is going to be credit. Credit is incredibly important, as you probably know. Credit is a numerical representation of how well you've managed your debts over the last couple of years. Okay. Now, you're going to see that your credit report, I'm going to keep looking to my right to make sure I'm not missing anybody here. You're going to see that your credit report has the most recent 7 years of information, but it's the most recent 2 years that really, really matter. the most recent 2 years. Even if you've had some issues in the past, if you've kept everything on time, kept your utilization rates low, made sure you didn't have any collections in the last 2 years, you're going to be in pretty good shape. Okay. Now, what's a good credit score? What's a bad credit score? Well, the bottom line is the best you can get is 850. Now, in my career, once a year, I might see someone with 3 scores over 800. Okay. 780, 760, 740, usually what I see. Sometimes we'll go down to 660. We can still work with a 60. We can even work with a 580. Once you're below 580, it's not a judgment. You're not a bad person. It's just an indication that a little bit of work has to be done. All right. The credit is that ticket to ride. Are you going to be able to buy a house? Now, the second point on that triangle is income. Okay. Now, when we talk about income, we have to talk about income a couple different ways. Number one, hopefully people are taking notes. If not, I am recording this and I actually should be able to send you guys a wrap up of the conversation of this presentation. Someone raise your hand. I just want to see if someone raises their hand, if I'm going to know. Mary, thank you. Meg, thank you. All right, cool. I appreciate that. Thank you for raising your hand. I'm going to go ahead and lower all attendees' hands. Unless you do have a question, go ahead and re-raise your hand. Okay, so now let's talk about income. We have to look at it 2 ways. Number one, income can be real income, but we're interested in qualifying income. What's the difference between real income and qualifying income? Well, real income is every penny that comes in the door. It's your base pay, your bonus, your overtime, your commission. It's all real and it all helps you pay the bills. Okay. Qualifying income, however, is income that we deem reliable moving forward. How do we determine if an income stream is reliable moving forward? Well, pretty much we look at the past, right? And that's why you're going to be asked for your most recent 2 years employment history, because we want to see how much money have you made over the last 2 years. Now, when you look at income, you want to break it down into streams, income streams. Salary is an income stream. Bonus is an income stream. Overtime is an income stream. Commissions is an income stream. Side work is an income stream. Second job is an income stream. FanDuel gambling winnings is an income stream. You have to look at each income stream differently because they're underwritten different. For instance, salary, as long as you have a 2-year work history or you went to school in the field that you're working and studied in the field that you're working, your salary counts at face value. There's no averaging. But then we get into overtime, we get into commissions, we get into bonuses. All of that has to be averaged out over a 2-year period. And that's why it's so difficult a lot of times when you're online to try and say, hey, how much do I qualify for? Well, if the lender's not asking the right qualifying questions, you might trip and find out, hey, I thought I was qualified for 500,000, but my bonus really wasn't averaged out correctly, and I only qualify for 400,000. So income is incredibly important. Now, once we figure out what that qualifying number is, now I'm going to give everybody some math to do. Okay, if you have your pen and paper, great. If not, I'll give you easy numbers. Number one, once we figure out that qualifying income number is, let's say it's $10,000 a month for easy numbers. We have to apply a percentage to that number. We can't just lend someone a payment of $10,000 a month. They're not going to have any money left over, right? So we apply a percentage. Now, typically, it's about 45%. So that's the number I usually use as our starting. So $10,000 times 45% is going to give you $4,500 per month. That's what we call your debt threshold. Your debt threshold. Okay. There's another term we call back end ratio, which is all of your debt divided by your income. So if all of your debt was 4,500 and your income was 10, you would have a debt to income ratio of 45%. All right. Everybody back in 9th grade algebra. I hope you're loving it. Now, once we figure out what your debt threshold is, in this case, $4,500, now we have to take out what you're already borrowing. Your student loans, your credit cards, your car payments, all of that monthly has to be deducted from that $4,500. What's left over is how much you can afford in a housing expense. All right. And that's how we qualify you on income. So if you had $1,000 worth of student loans, credit cards, and car payments, we deduct it from the 4,500. You would qualify with a payment of $3,500 a month. And then the next question is, well, how much can I buy for that $3,500 a month? And that is a little bit of a moving target because that 3,500 has to include taxes, has to include insurance, and of course, it has to include the mortgage payment, the loan repayment. But that's essentially how we drill down what you qualify for on a monthly basis. If we get crazy, I might show you a calculator later that I think you guys might like. Assets, third point of the triangle. Okay. How much money do I need to buy a house? Well, I don't know. How much does it cost to buy a car? Right? Like it's an open-ended question, difficult to answer. But what I can tell you is that when you purchase a house, you're going to need money for closing. It's going to be made up of three components: your down payment, which varies depending on program. We'll get into that a little bit as well. Your non-recurring closing costs, and what we call your prepaids. Now, your non-recurring closing costs are going to be transfer tax, title insurance, lender fees, recording fees. These are things that you pay, but you only pay them one time. You don't pay them again for as long as you're in that loan. Now, the third is your prepaids. Prepaids are taxes and homeowners insurance that you are required to pay in advance. Okay. Taxes and homeowners insurance that you're required to pay in advance. Now, depending on where you buy, that could be 12 months worth of taxes or it could be 6 months worth of taxes. In Delaware and in Pennsylvania, they pay their taxes annually, which means you have to have 12 months worth of taxes at the settlement table. So if you're buying a house where the annual tax bill is $8,000, a portion of your prepaids is going to be that $8,000. If you're buying in New Jersey, the taxes are paid quarterly. So you don't have to have as much money at settlement on a Jersey transaction as you do on PA when it comes to prepaids for that reason. There's also no transfer tax in New Jersey for home buyers, which really does help with the cash to close. Not that I'm trying to convince everybody to move to Jersey, but your taxes, homeowners insurance, and a little prepaid interest. Now, when you add those three numbers up, that's what's going to give you your total cash out of pocket. Now, a lot of times when I'm talking to my pre-approvals, I'm talking to my home buyers, I ask, how much money do you have earmarked for this transaction? Sometimes I get, well, how much do I need? Well, okay, we'll get to that. But sometimes people are saying, hey, I have, $10,000 that I can use towards, or $80,000 that I can use towards my down payment and my closing costs. Well, maybe you don't need to use all that, right? It could be that you just have to figure out how much, what monthly payment feels comfortable. How much cash do I actually want to keep? What if you didn't need to put 20% down? What if there was a program where you could get some help from the state for some closing costs? Would you be interested in that? And a big question a lot of people don't ask is, what flexibility do I need going forward? If you know your car is going to break down and you're going to need a new car soon, you're going to be real careful not to borrow up to your maximum debt to income ratio because you're going to want to leave, a little bit of room. So it might make more sense, to put more money down or to put some money aside and maybe not finance as much on the car. Okay. Those are the three areas of risk that we have to analyze. And what happens when you go through the pre-approval process is we're gonna go step by step and explain with your credit score, with your qualifying income, with the areas that you are looking in, and with the amount of money that you have, which program we think is best for you. Now, how we do that is we start with an intro call. Hey, where are you thinking about looking? What do you do for a living? Do you like your job? That's a good one, right? Because you're like, I hate my job and I want to quit tomorrow. Whoa, we gotta get qualified for a loan, right? I can't have you quitting your job, although I did have that happen. And then from there, you fill out an online application. Now, most mortgage companies, the online applications have come a long way. Ours happens to be incredibly conversational, a lot of AI backed, tools that allow, borrowers to fill out the application, ask questions along the way and get answers in real time. That's super cool. Once that's done, from there, we're going to put together a recommendation. and we're going to schedule a call where we go through that recommendation. In fact, I think some of the folks on this call have a recommendation call coming up. Now, in the recommendation call, we're going to cover what the underwriters are looking for in a mortgage application, and how you fit that mold, like a lot of what we talked about here. We're going to talk about a monthly payment scenario, how we come up with that monthly payment scenario. We're going to talk about a cash out of pocket scenario. How do we come up with the cash out of pocket? And ultimately you're gonna get a really cool picture of what your transaction might look like. That's called the recommendation call. And then from there, you're gonna get out there and you're gonna start looking at houses. Before I move on, does anyone have any questions? Now's your chance. I'm looking over here. Anyone raises their hand, I will bring you on to ask your question, not your picture, just you'll be able to talk. So far, so good. Okay. We talked about your monthly payment. What makes up your monthly payment? Again, principal and interest, real estate taxes, homeowners insurance, mortgage insurance if applicable, and your HOA if you decide you want to buy in an association. Now, a couple things I want to talk about mortgage insurance for a minute. I think mortgage insurance gets a bad rap, right? A lot of people are like, oh, I don't want to pay mortgage insurance. I don't want to pay mortgage. I want to put 20% down, or worse, I want to wait to save money to have 20% down. I want to wait to save money to have 20%. If you're saving 4 or 5% of the sale price per year, it's going to take you 4 years to save up that 20%. Do you know what's happened to the real estate in the last 4 years if you had bought and put 5% down? Right. It's gone up in value. So now it's gone up in value while you're waiting to save. So the same house that you could have bought 4 years ago is now going to be more expensive. So what do? Well, you just take out mortgage insurance. Mortgage insurance is an insurance premium that's paid by the buyer to an insurance company. If something happens, if the buyer's unable to make a payment and the loan goes into default, the mortgage insurance kicks in and pays the lender for the 20% that you didn't put down. It's phenomenal. Now, in the old days, mortgage insurance was very based on what we call loan to value ratio. There's a little some lingo for you. Loan to value ratio. If you're putting 5% down, you have a 95% loan to value ratio. If you're putting 10% down, you have a 90% loan to value ratio. If you're putting 15% down, you have a 85% debt to income ratio, right? Simple math. Used to just be based on loan to value ratio. Now they take into consideration how many borrowers, debt to income ratio, credit score. So in some ways, folks with really good credit, they get better premiums than they used to. Some cases, it's very, very nominal. And if your credit isn't the best, yes, maybe your mortgage insurance might be a little more expensive. But again, balance out the idea of maybe having to save for 4 or 5 years over paying mortgage insurance. I think you might find that you're better off. Your HOA fee, if you're buying in an association, is not included in your mortgage payment, but it is included in your housing expense. So it's not included in your mortgage payment, but it is included in your housing expense. So we're running your debt to income ratio. Of course, we have to take that into consideration. Some questions I typically get is why taxes can swing payment hundreds of dollars a month. Well, think about that for a second. Again, I like easy math when we don't have a calculator or, I'm not able to demonstrate. But let's just say you're looking at one house that has a tax bill of $6,000 a year, and you're looking at another house that has a tax bill of $12,000 a year. Okay. I don't know if there's any Dollar County folks on our call today, but look at places like Drexel Hill. Drexel Hill's taxes compared to the sale price, very, very high. Okay. But let's go back to that analogy, 6,000 versus 12,000. Sorry, I didn't mean to, knock Drexel Hill. If you have to pay those taxes in your mortgage payment, you're going to divide that number by 12. So if the taxes are $12,000 or $6,000 a year, $500 a month of your mortgage payment is going towards the escrows for taxes. Well, if your taxes are $12,000 a year, now $1,000 of your mortgage payment is going just to the real estate taxes. So the same house in two different neighborhoods where one tax bill is $6,000 a month and the other is $10,000, excuse me, a year, $6,000 a year versus $10,000 a year, that's going to have a dramatic impact on your overall monthly payment. And that's important because your payment plays into your debt to income ratio, which plays into your affordability, which plays into your approvability. So when someone pre-approves you to say, hey, you're good up to 350,000 or 400,000 or 250,000, what does that really mean? And if you're not careful, you might say, oh, I'm good up to 350,000. You run out, you fall in love with a house that's 350,000, only find out the taxes were higher than expected. And now you may not qualify. That's a devastating situation to be in. You really don't want to be in a spot where you don't qualify for a house you fell in love with. Why new construction taxes surprise people? New construction, the tax bill is going to be based on the sale price, whereas the rest of the existing construction is based on the assessed value. Now, there's ways to appeal the taxes after you buy the house, but you really want to be careful when you're buying new construction because you have to know what the millage rates are for the municipalities and essentially what that final sale price is going to be. And that's going to tell you what taxes are that you have to qualify them. Now, again, maybe you can appeal it and get those taxes down, but you still got to be really, really careful. Any questions on taxes, on the makeup of the mortgage payment? Don't see any hands raised. All right. Where's the money really go? We talked about the three components to your cash out of pocket number. You have your down payment, you have your non-recurring closing costs, and of course, you have your prepays. Let's talk about down payment for a minute. Your down payment is not your deposit. I'm sure the agents on our call here tonight will appreciate that I'm sharing this information because some people are like, oh, I put 5,000 down. I put 10,000 down. That's just your deposit when you put your contract in. That's going to come off of your total cash to close number as a deposit. It's not your down payment. Your down payment is what percentage of the sale price are you putting down? What percentage of the sale price is coming from you? Now, with conventional loans, first-time buyers, you could put down as little as 3%, which is awesome. With FHA loans, you could put down as little as 3.5%. With VA loans and USDA loans, you could put down as little as 0%. If I have any veterans on the call, VA mortgage is single-handedly the best mortgage product on the planet, and it is for eligible veterans. So how much you need to put down is going to depend on which program we decide to go with, which program we think is going to be best for you. Now, a lot of people use the term, when we get into the closing costs, people use the term junk fees. Well, what you're going to find is that there's two types of fee structures. One is an itemized, and I prefer that. It's a little more transparent, although it looks like you're being nickel and dimed, but those are actual pass-through charges, meaning that they're not charging you, they're not upcharging you. They're saying, here, this is what it's cost. These are the items that we need to pay for in order to get the loan approved and to the settlement table, and it's a pass-through charge. Others lump their fees together and charge everyone the same amount. Neither here nor there. Okay. At the end of the day, though, you really do got to look at those fees because it's the fees that could tell the whole story around the cost of the loan. Some people just look at interest rate. The bottom line is, if you're only looking at interest rate, then you're not looking at the fees. Then you might find out that the loan is actually more expensive, even if the rate might be a little bit lower. So you really want to take a look at those fees. Now, what are different if for any of our second-time buyers out there, or anyone who's gone through the mortgage process, a couple of years ago, even for my agents that are on this call, credit report fees have skyrocketed. When I first got into business in 2004, no, 2003. When I first got into business in 2003, credit report fees were $45 for two borrowers for what we call a tri-merge credit report. Now it's close to $350. They've gone through the roof, especially in the last year. So that's one of the things that's changed. Now, one of the other questions we get is why lenders cannot guess fees accurately without real data. This is a hard one. People are like, oh, what are your fees? Well, Where are you buying? What program are you using? What's your credit score? What's your debt to income ratio? All of this goes into the type of program, the interest rate, and the fee structure. So it's difficult to just say, oh, these are the fees, right? You really do have to have a comprehensive um, application so you could give someone an idea of what it is their actual costs are going to be. And we talked about conventional first time buyer options. So let's spend a little bit of time on that. First, back it up. Any questions? Don't see any hands. Don't be surprised if I call. Nah, I would never call on anybody. That's not fair. All right, no questions. So conventional first-time buyer options. The best first-time buyer program for conventional is Fannie Mae and Freddie Mac both have a version of this. One is called Home Possible, one is called Home Ready. It allows for a 3% down payment. And depending on your income, if you're at or below 100% of the area median income, then you're eligible for reduced interest rates, discounts on your interest rate, discounts on your mortgage insurance as well. Okay. So the Home Possible, Home Ready are the two programs conventionally that I think are the best for first time buyers. The veterans and special eligibility programs. Now, we talked about veterans zero down. Another great feature with veteran loans, VA loans, is that there's no monthly mortgage insurance. So that's like another, could be 100, 200, shoot, in some cases, $300 better, especially if you start to get to the lower end of the credit score channel with no MI. Whereas if you look at the risk-based pricing on a $300,000, $400,000 house, that MI could get a little bit expensive if you're putting, minimum down. But in this case, zero down, no mortgage, no monthly mortgage insurance. Phenomenal. Assistance programs. I believe I have another slide that talks about assistance programs, I think, but I want to jump ahead and I want to jump back. Okay, so I don't think all right. So assistance programs in PA, I think everybody on here is in PA. We have something called the Pennsylvania Housing Finance Agency, PHFA. Now, the Pennsylvania Housing Finance Agency is a state chartered organization whose job is to facilitate homeownership throughout the state of Pennsylvania. And what they do is they offer different programs to borrowers to help them get into a house. Well, for most first-time buyers, the number one barrier to getting into a house is cash. Let's face it, right? Saving up the money for down payment and sign-on costs. Well, PHFA has programs. One of them is called KFIT. And I know a couple of the agents on the call here know what KFIT is. KFIT stands for Keystone Forgivable in 10. That's the FIT part. So the Keystone Home Loan is a program that allows you to borrow at a reduced interest rate in a lot of cases, but it has an income restriction. Now, with this one, you can't make more than 80% of the area median income to qualify for the KFIT or for the Keystone Home Loan. How many people are living in the household increases that minimum income number. So it's not a static number. It depends on how many people are going to be living in the household, how many kids, parents, grandparents, even all household members contribute to the increased income limits. And then you can get up to a 5%. Okay. You can get up to a 5% interest-free second mortgage. By the way, if anybody has any questions, like if you want me to send you any information on this, you should have received an email with the presentation. Reply back to the email. Let me know if you want any more information on the PHFA. A 5% interest-free second mortgage that does not have any payments. You don't make any payments on that second mortgage. So if you're buying a $200,000 house, you literally get $10,000 in funds that you can use towards down payment and closing costs. $10,000 towards down payment and closing costs. And it's forgivable, which means that if you're in the house for 5 years, you only have to repay half of it. If you're in the house for 10 years, you don't have to repay any of it. So it's a phenomenal program for first-time buyers. If you're not a first-time buyer, they have something called K-Flex. A little bit different, same structure. Income limits are higher. You don't have to be a first-time buyer, but the interest rate's also higher. Okay. That's what I mean by we got to figure out which program is going to be best for you. There are so many programs out there. My job is to save you your lender's job. Again, this is not a Ken Jordan commercial. Your lender's job is to save you hours and hours and hours and hours of Google searches, right? Distill out the information that doesn't pertain to you. Work with you to uncover which program is going to be best for you and then focus on that program. All right, let's see where we're at next. The pre-approval process. So we talked about the recommendation call. Now, once you go through the recommendation call, you should have already provided your W-2s, your pay stubs, and your bank statements. Okay. My favorite way to tell you how much what documentation you're going to need is a 222. 2 pay stubs, 2 W-2s, 2 bank statements. 222. Okay. Now, once we have that information, we can issue the pre-approval. Now, what Princeton does, not all lenders do it. I know a lot do, not all of them do. We issue what's called a fully underwritten pre-approval. That means, yes, at some point you are going to have a pre-approval, but if you provide the 222, we can then put that information in front of an underwriter, okay, and let them sign off on your credit. And now you have what we call fully underwritten pre-approval, meaning it's essentially as close to a cash offer as you can get. The loan portion has been approved. You still got to find a house, get the homeowner's insurance, get the title insurance. It's not a done deal by any means. But listing agents love the fully underwritten pre-approval. When they're sitting in front of their seller and they're all presenting 4 or 5 different offers, if one's got the fully underwritten pre-approval, I promise you that listing agent is letting the seller know how important it is that this buyer's already been through underwriting. It's removed a lot of variables. Okay. So be prepared to provide the 222. Okay. 2 pay stubs, 2 W-2s, 2 bank statements. Okay. Now, let's say you are issued a pre-approval. Let's say it's for 300,000. What are the odds that you're going to go out and find the exact house that you were pre-approved for? Well, pretty slim. I mean, granted, if you came in with a house, hey, Ken, I want to buy this house. Can you pre-approve me for this house? Yes, then we're going to have pretty dialed in numbers there on what that pre-approval is going to look like. But a lot of folks come to us like early on, they don't have a house yet. Now they got to go out and shop for a house. So you really want to know not just what do you pre-approve for, but also what would my monthly payment be on this house? And in some cases, am I going to be pre-approved for this house? So let's get crazy. I'm going to get into a screen share here that I'm going to share with you one of the things that we do, again, that we love for our pre-approvals. And again, this is not a commercial for Ken Jordan and Princeton Mortgage. Okay. So we have a really cool tool that is essentially a calculator. And what this calculator does is it allows you to run numbers on any property that you see. Okay. Now, you go online, challenge you, go online tonight, find a house, then go on 4 or 5 different real estate websites. You're going to find that the numbers you get from 5 different sites, you're going to get 5 different monthly payments, 5 different cash out of pocket. It's almost impossible for these websites to truly pin down what your monthly payment and your cash out of pocket are going to be. But when you get pre-approved with us, we're actually going to build you out a custom calculator, custom to you. Okay. Now, in this case, let's say you're out looking at houses and you come across a house that's 325. Well, you put in 325. And then you want to put 5% down. Well, in this case, this person can only borrow 175.5, so they can't put 5% down. But let's say let's lower this to 200,000. Okay. And now we want to put down 10%. Is that going to let us? No, 46%. Okay. So in this case, the maximum monthly payment or the minimum down payment is going to be hard coded in this. Okay. And in this case, the person's borrowed 108,000. Don't forget, we got to put taxes in here, right? So we're going to put 6,000 in taxes. We're going to guess on the homeowner's insurance. but we'll give you a rough idea of what we think it's going to be. And then HOA fees. And then on this calculator, which is right on your phone, you're going to be able to see what your monthly payment would be on this particular property and what are my cash out of pocket? What's my cash out of pocket going to be on this particular property? So instead of guessing or trying to chase down your loan officer or use some online calculator, you're going to have it with you at all times. Okay. Now, look, here's the best part. Let's say the numbers work. Let's say the monthly payment is below your debt to income ratio. The cash out of pocket is below what we've verified in assets. You're going to be able to issue a pre-approval letter right to your phone that has today's date on it that says, hey, you're qualified to buy this house. And if you go through the fully underwritten pre-approval, this gets converted to a fully underwritten pre-approval automatically so that when you're out there, you can print an fully underwritten pre-approval for any property that you find that you like. This is incredibly popular. Folks love it. They like to use it. They like to go online and look at houses, and then they like to run the numbers and see what their monthly payment and their cash out of pocket are going to be. Super cool tool. Now, what do listing agents look for in your offer? Okay. Well, for one, not going to lie, if the listing agent knows the lender on the transaction, that's going to give you an advantage. Listing agents want an effortless transaction just like you do, just like the buyer agent does, just like the buyer does. Everybody wants the seller, everybody wants an easy transaction. When you know the lender on the other side, that gives you confidence, especially if they have a good reputation, that the loan's going to close without hassle. If they don't have a good reputation, that could be detrimental. That could be extremely detrimental. And that's why a lot of folks choose to go with the real estate agent's recommendation for a lender. So if your agent says, hey, I think you should call Ken, there's a reason for that because they know that when Ken puts a pre-approval letter out, if the other agent knows Ken, that's going to help make that offer even stronger. Okay. What we do is when you put an offer, we reach out to the listing agent, introduce ourselves if they don't already know who we are, or call them and catch up if we do know who they are. And our goal is to let the listing agent know, like, hey, these guys have done everything they're supposed to do. They're in really good shape. You know, they're strong buyers, and really we're excited for them to get the house. Um, if you're working with the right people, that's going to be a distinct advantage. Let's see here. So, what are some of the mistakes that first time buyers make? One, and this is my favorite, waiting too long to get advice. Now, falling in love with a house before you've been pre approved is an emotional trap. You just don't know. Like the pre-approval is making sure that you don't go out there and you don't look at a house that you can't buy. Not realizing that if you had just paid off a couple of credit cards, your scores might have gone up 40 points. That first time buyer program I was telling you about, that requires a 660 minimum credit score. Spot 658, no go, no dice. You need to have a 660. So sometimes in the pre-approval stage, we might say, hey, pay off this little credit card, do this. That's going to bump your score up a little bit and help you to qualify for the program. Making financial moves mid-process. Remember when I said earlier that I actually had somebody quit their job mid-transaction? Don't do that. Whatever you do, don't do that. Quitting your job mid-transaction, buying a mattress, 12 months financing, same as cash, buying a car, financing anything after you've been pre-approved without first talking to your lender is hazardous. Okay. Don't make any major financial decisions after you've gone through the pre-approval process without at least letting your lender know. Letting internet advice override real guidance. This is becoming a bigger problem. We all know with the advent of ChatGPT that information is not just at our fingertips anymore, but in a way that really helps us make good decisions. And there's a lot of good stuff that AI is doing. But what I also know is that it can be wrong. And it's not just wrong if you don't ask the question right, which is pretty common. It's wrong sometimes, even if you ask the question right. There are times where, an underwriter might have a decision and I go on ChatGPT and ChatGPT disagrees with the underwriter. Well, guess what? The underwriter was right. And it's happened more than once where you just can't rely 100% on AI to answer your questions. Sometimes the information that they have is outdated. The authority source, data source may not be the correct authority data source. So letting the internet, letting AI override real guidance from a real lender who's been doing it for, for a period of time can be a hazard. And of course, falling in love with the house before understanding the numbers, which if you've gone through the pre-approval process with the right lender who executes the right way, you should understand the numbers. It's not just about getting the piece of paper. So we talked about what does it mean when you're getting ready to write an offer? Well, this is where your agent comes into play. And like I said, I got a couple agents on the call here tonight, and I will tell you this. Your agent should know the contract. Your agent should know the area. Your agent should know the comps, and your agent should know how to negotiate. That's the bottom line. Your agent represents you, and the agents that I work with are phenomenal negotiators. That's a huge plus. They're not just opening a door so you could see a house. They're going to make sure that the contract is drawn up to protect you. They're going to make sure that you can use whatever leverage you have to improve your situation, i.e., the negotiation. They're going to understand the finance terms. They're going to understand the intricacies of the program that you might be going into. How quick is too quick for a closing? How long is too long for a closing? They're going to have all those answers for you. And that's why at this stage, when you're getting ready to write an offer, we will talk to you about, okay, here's what your monthly payment's going to be. Here's what your cash in our pocket's going to be. If you would go with this program, this is what to expect. If you go with this program, this is what to expect. But then from there, let your agent take the wheel. Okay. They're the pilot. They're flying the plane. Let them fly the plane. Let them bring it in for a landing. Now, what does success actually look like? Well, if you've gone through the pre-approval process, you should feel clear about your monthly payment. You should know what your boundaries are, what your upper limits are from an affordability standpoint and a comfort standpoint. Remember, the pre-approval is sometimes about what you're able to do, but it's up to you to figure out what you're willing to do, right? Just because you're able to go out and borrow $650,000, the $5,000 monthly payment doesn't mean you should. Okay. So that's an important thing to think about, having options and being able to move quickly when the right house shows up. All right. What you see here is my email address and my cell phone number. You can, hopefully, you got an email with this presentation, and you're welcome to shoot me a text. Anybody that shoots me a text, the first person that's in the group today that texts me, I am going to cover their appraisal fee for when they go under contract. And you have 15 seconds to reply. I'm looking at a couple names who should be super excited to jump on this. Use that cell phone. There it is. Nice job, Hank. All right. You were first. You were first. So we're going to waive that appraisal fee for you. Remind me. Don't let me forget. Okay. Questions. Does anybody have any questions? Raise your hand. Raise your hand. Raise your hand if you have any questions. Let's see here. Anybody else come through? All right. I got a question here on soft pulls. So what is a soft pull? A soft pull is a way to take a look at your credit profile without doing a hard inquiry. Now, hard inquiries go on your credit report. Too many hard inquiries could affect your score. Okay. But it doesn't always affect your score. If you're out there running your credit willy-nilly, yes, your scores are probably going to be impacted if you're out there running your credit doing hard inquiries. But the hard inquiry gives the lender the information they need to issue the pre-approval and then execute the actual approval off of the same credit report. Okay. And you don't pay for it. It's not you. Soft pulls have become incredibly popular over the last couple of years with lenders because they pay for it. Remember what I told you what a credit report costs? Well, soft pulls are a lot cheaper. The problem is you're not guaranteed to get all the information, and you have to pull a new credit report at some point. At some point, you have to pull a new credit report. That might be when you're ready to put an offer in. Or it might be after the offer has been accepted and now they're ready to submit it to underwriting. Any changes to your credit profile between the time the soft pull is pulled and the time that you go on the underwriting are going to have an impact on your file. If you're a listing agent, you're asking the questions. Is this pre-approval on a tri-merge full credit report or on a soft pull? Because if it's on a soft pull, that's a huge variable that could impact their ability to actually go to closing. Whereas if it's a full tri-merge, you know that credit report's good for 120 days. It does not have to be repulled just because you went under contract. Even if you go under contract and the deal falls apart, you go back under contract, as long as that credit report's it's less than 120 days, it's still a good credit report. The data is what they're going to make the decision on. Soft pulls equal variability. Variability equals gray areas. Gray areas equals possible problems, and you know, on and on. So yes, they are getting popular because they're cheaper for the lender. I personally don't like them. I think you should do a full pre-approval, but they are available. So that was a great question. I have another question. Minimum credit score. Minimum credit score. It depends on the program. FHA will say they go down to a no minimum credit score. The reality is most lenders won't do that. We go down to a 580, okay? But you have to really have some other strengths. Remember that triangle? If you're going with a 580 credit score, that means the credit corner on your triangle is weak. Your assets and your income have to be strong. You have to be strong in those other two areas. Might require a 10% down payment. Even though the minimum down payment's only 3.5%, it might require a 10% down payment in order to get approved. Conventionally, they're at a 620 minimum credit score. But again, that still has to be underwritten and approved through the automated underwriting engine. So, your credit score really could be a little bit higher and still not get approved. It depends on whether or not you're borrowing a ton of money, you don't have a whole lot of reserves, or if you do have a whole lot of reserves, that helps. Minimum credit score. Any other questions? Take a sip of my water. Okay. All right. So what's the next step? Well, the next step is if you're interested, like I said, I know I have a couple of recommendation calls and intro calls already scheduled with some of you folks. So our next conversation is going to be a lot of review, but I hope you learned something. If you are interested in an intro call, please don't hesitate to reach out. I will send you my calendar. You can grab a half hour that works for you, and you can go ahead and schedule that call. Otherwise, it's 7:19. We were here for 50 minutes, and you guys were gracious enough to let me do all the talking. I really, really, really appreciate it. If I can help you in any way, shape, or form, please don't hesitate to reach out. Our job is to make this effortless, and this is not it's a commercial for okay. All right, it's a commercial for Princeton Mortgage and Ken Jordan. But we are here to help you in any way that we can. I hope you have an awesome night and get out there and start looking at some houses.